recording. Probably my own fault. I should probably tell them, look, you're not getting the recording unless you show up live.
You mean I get the privilege of one-on-one with you?
Yeah, well, not quite. I mean, there are people here, just not with their cameras on.
Okay.
And for that matter, while we're here, just quick housekeeping. If you are here watching camera shy, you can unmute and interrupt me if you do come up with any questions while I'm talking. I won't be offended. It's okay to interrupt me. And speaking of the recordings, you can access all of these recordings on my website. It does require that you get a login on my website, which is free, right? Most of you probably already have it, because I think when you sign up for one of these webinars, I think my site automatically, if you don't already have one, creates a login for you, and you get a bunch of emails saying, here's your username and password. And some people thought those were spam, so I actually put a message in the autoresponder that says, this is legit. So anyway, most of you probably do have an account. Just go to new.nerdenterprises.com/login to log in, and then you're in your course locker, which is up here on my screen. You'll see Nerd Buzz, which is where all this stuff is. And when you go in there, you'll find this category, the Bulletproof Bookkeeping webinars and more. And that's where all of the recordings are that I've done on all these. The last one we did a couple weeks ago was this one, how to set up a new company in QuickBooks Online, which, as you can probably guess, there's going to be some overlap today with what we discussed in that one, because obviously when you're setting up a new company in QuickBooks Online, one of the first things you're thinking of is setting up the chart of accounts. It wasn't a coincidence that this was the topic that followed, because that was more of a bigger picture overview of, sort of things to know when you're setting up your company in QuickBooks Online. This is obviously specifically focused on the chart of accounts. So let me bring up my notes here. So of course, when you are setting up a new company in QuickBooks Online, you're going to, wait, hold on. So somebody is providing some feedback there. So don't be offended. I'm going to mute you. Feel free to unmute if you do want to speak. But I'm just going to keep most of you muted just to avoid that background noise and feedback that can come up. So as I was saying, when you're setting up a new company, as I mentioned, of course, one of the first things is, you're thinking about setting up the new chart of accounts. And as many of you, I'm sure, maybe all of you know, when you're in that sort of interview that you go through when you're setting up a brand new company in QuickBooks Online, you're going to get to that part where it asks you to choose what industry the company is in. And essentially what they're really asking you is if you want them to populate kind of a standard chart of accounts that consists of accounts that are commonly used in that industry. And so of course a lot of people just do it because they don't really make it clear that that's really the decision you're making there. So a lot of people just pick the industry because that's what makes sense to do. And when you're new at this, you might want to do that anyway, because it can certainly help, and you can always make accounts inactive if it turns out there's one you don't need. And obviously, if there's one you need that's not there, you can certainly add it. So it's not a terrible thing to go along with that. But what I want to throw out there, because this was my experience, even back in desktop when we had the comparable interview when setting up a new desktop company, at a certain point, I started just choosing other or none for the industry, because that populates a minimal list of accounts in the chart of accounts, and that really gives me the ability to customize exactly what I want included, and include only the things that I want, none of the things that I don't want. A lot of times I have different ideas than, let's just call it normal people have about how I want the account set up. I'm a little abnormal that way. And it's also because, frankly, joking aside, after years of doing this, I have found that when you structure your chart of accounts a certain way, and we're going to go over some examples of what I'm talking about today. There are, when you really kind of get sort of skilled at this, I guess, for lack of a better way to put it, you start realizing that the way you structure the accounts, especially in certain areas, it lends itself to certain workflows, really, right? And the way the money flows, when you set up certain accounts for certain types of industries in a certain way, it makes it really easy to follow the money. And that so the way you set up your chart of accounts, there's, I want to say there's almost no right or wrong answers on this. It's really a matter of, and this is what I want to impress upon, like if people take nothing away from this other than this one point, I hope this is the thing you'll take away, which is that I really want to encourage everybody who's watching this to think in terms of, when you're creating the chart of accounts, think about the fact that you're painting the picture of what things are going to look like on the P&L and on the balance sheet. right? That's the key I really want you to take away from this. And so when you're asking yourself, how should I set up the chart of accounts? You should really, in answering your own questions, think in terms of, what do I want this to look like on the profit and loss, right? Remember, we or our clients put all this money into creating a beautiful set of books for one main purpose, which is the information we can get out of it, right? The money, the time we spend on the inputs is all so that we can get the outputs, which of course is reports, right? Which is why in the Bulletproof Bookkeeping course, I have it structured exactly the way I do, where near the end of the course is a whole section on management reports, right? Because to me, after you learn how to do everything else, then you want to know how to get good information out of it. And that's the way you do it, is by, by starting with the obvious basic reports, your balance sheet, your statement of, oh, well, heaven forbid, your statement of cash flows. A lot of people don't understand that statement, especially when you're new at this. And of course, the profit and loss, right? And so I always encourage the accountants and bookkeepers that I work with to try and take the time to explain the statement of cash flows to your client, because number one, the value of your stock in their eyes will skyrocket just because you took the time with them, and especially if you know how to explain it well. Obviously, before you can do that, you have to understand it really well. And of course, I've got videos on that. In fact, I've got a whole section in the Bulletproof Bookkeeping course that goes, it's the deepest dive I've ever done. It's actually an hour-long video on the statement of cash flows, and where I go through a whole series of transactions using T accounts and explaining exactly how, as you post each transaction, I illustrate and show you how it impacts actually all three financial statements, but really with an eye towards what it looks like on the statement of cash flows. So my hope is that people walk away from that lesson in particular with a very thorough and deep understanding of the statement of cash flows, because then you'll be able to explain it to your clients, and that will help. It will help you to get better information from your clients, and vice versa. If you have the patience and the understanding at a deep enough level to be able to explain the statement of cash flows to your clients, it will make a huge difference. And it will also reinforce what I'm saying in terms of why it's so important to think about how the accounts are going to be structured on the balance sheet and P&L, because that's going to make a big difference in terms of how you read those financials, right? So quick example, I was in a thread in one of the Facebook groups the other day, and somebody was asking where they should post their QuickBooks Online full service payroll fees. And some people, surprisingly to me, actually said that they put it in software. Actually, a lot of people said that. And again, it's not wrong. And some people said, well, an expense is an expense. And that's where I do take exception, because if you deprecate it like that, I think you're misleading yourself, if not others, because again, that minimizes the point I just made, which is that you shouldn't take that approach of an expense as an expense. You should take the approach of, how do I want this to look on the financial statements? What is the point of analyzing payroll processing fees? Well, specifically there, I want to know what it's costing me to process payroll every month, right? Payroll is usually the biggest expense in any company. So the fees that it's costing me to process those payrolls, something I probably want to see very distinctly. And so I include it, and I'm going to illustrate this later when I go through the part where I talk about how I structure the whole payroll section on the P&L. Payroll processing fees get their own line item as a sub-account in the whole payroll expenses area, right? So I'll dig into that and show you that in a few minutes. There are certain sections of the chart of accounts that are fairly standard across most industries. And then there are areas that can be very subjective in terms of how you structure them, right? Adding an account in QuickBooks Online is easy enough, but let's illustrate that just to make sure, in case there's somebody here watching now or later, that hasn't even gotten that far yet. When we go into QuickBooks, we're going to go into accounting and the chart of accounts. And of course, you're going to click new here, and you're going to see your options in terms of adding a new chart of account. Right now, most of this is straightforward. Most of us, I can tell from the names here, because I know most of you. Most of you all, I think this is like, somebody just left the meeting, I think, because they just thought I was getting too basic for them. But seriously, this is all pretty straightforward. Even if you're very inexperienced at this, you're going to go through and pick what's the appropriate account type. Is it a bank account? And if you aren't experienced, then I urge you to take the time to look through your choices and obviously find the most appropriate thing when you're not sure. These can almost always be changed later on. The detail type is not as important, but I still urge you to pick the closest thing possible. I'd meant to check this before today, but one of the things a client mentioned to me some years ago when we were looking at this, and the client wanted to know specifically, could they access the detail type in the reports? In other words, if you could, that might be kind of a simplified way of viewing the chart of accounts with broader categories. It might be useful. And I meant to check, I thought about it. I don't know if there's a way to bring, I know there's not a way to bring this directly onto any report, but I know it does appear if I run a report that shows me the account listing, right? So if I go, let me cancel this. If I go over to reports, and I'll just use the search real quick. If I go into account list, the detail type shows up here. So if I wanted to, if it was really important to me, and if I thought the data would be useful, I could run a P&L, standard P&L, and I could run this report. I can export them both to Excel and start doing VLOOKUPs on the detail type to create a simplified version of the P&L that's based on the detail type. And it might prove to be useful to be able to look at the information that way. The basic purpose of the detail type, as I'm sure everybody here probably already knows, is for tax line mapping if you happen to be using Intuit Pro Connect to do your taxes. But I heard a rumor maybe a year ago that it's not even used for that anymore, that they decided to do away with it or something like that for some reason. So it may not matter at all. In theory, sometimes I tell the bottom line is this. Let me put it this way. Don't kill yourself trying to figure out what the right detail type is. Just pick the most appropriate thing you can find. And if it's not real obvious, when you get into things like expenses, you'll see that you can always choose, if everything else doesn't look quite right, you can always choose office or general administrative expenses, right? Or other miscellaneous, whatever. Just pick something, but take a minute to try and find the most appropriate thing. I guess that's what I'm really trying to say. Let me bring up my participant list. It looks like we've got some more people who've joined. I'll let some people in. Okay, and then I'm going to bring up the chat screen just in case somebody's trying to chat. And then there's the Q&A. Now I got all bases covered in case people want to chat or ask questions. Most people just ask questions in the chat, which is totally fine. I'll look back and check in here periodically. All right, so we know how to create a new account. That's easy enough to do. Again, we're in accounting, the chart of accounts, click new, and it's pretty straightforward from here. First, you pick your major account type. Should you put a description? Yeah, if it helps, if it's not otherwise obvious what the account's purpose is. And obviously, when we want to create a sub-account, this is where we do it. The parent account needs to be created first, or you can create parent accounts on the fly, right? Or can you? No, it actually doesn't. Sorry, from this dialog, it doesn't let you create a new account. So you have to create the parent account first that you want to use, or go ahead and create the sub so you don't get, you don't totally waste your time. Excuse me. Go back, create the parent, and then edit the one that was meant to be the sub and make it a sub account, right? Because I do that a lot. I'll go create an account, and I'm creating the child account first, not realizing or forgetting for a minute that I still hadn't created the parent account yet. So anyway, just, simple little things. I don't know why in some dialogues like that, you don't have the option to create something new. But I don't presume to know what it takes coding wise. We would have to ask somebody into that question. Again, adding accounts is easy. The detail type is not that important. I would just try and find the most appropriate thing, but don't kill yourself over it. And then, like I said before, there are certain sections of the chart of accounts that are going to be fairly standard. One report that I do like to run that just helps me see the whole chart of accounts in a list is, of course, the trial balance report. So again, if you're very new at this and you're totally unfamiliar, go into reports and you can search trial balance and get this report. And if you run it for all dates, in this case, there's no data in this company file. It's the same new company that I created in the last webinar where I was going over how to set up a new company file. So we never actually posted any transactions, right? And by the way, that's a good way to check, right? What's on the books? Where is it on the books? Is run the trial balance. The other thing I like to do is just run the balance sheet and I'll run the balance sheet for all dates, and I'll total it by year. That's a good quick way to see if you're looking at somebody's company file for the first time. It's a good quick way to see, how far back these books go, right? So again, these are these little tips that don't necessarily have anything to do with creating the chart of accounts, but while we're talking about the accounts and the reports as they tie in, I think it's useful information, to know that. But this is often the first thing I'll do when I get into a company file is run this exact report, because I just want to see how far back do the books go. I used to do this all the time in desktop. And it's just something that, it answers a question I often have. So back to the chart of accounts. Let's take a look at some of the fairly standard stuff that I was referring to that we're going to want to, look a little closer at how to set up. And I had mentioned, what do I set up and why do I set it up, or why don't I? And so I already mentioned payroll is kind of a critical area as far as this stuff goes, right? So let's drill into payroll. And I mentioned this earlier. So here's what I typically will have for payroll of salaries. If we have an S Corp, then I definitely need officer salaries as a separate account, right? And if for any other reason I want to separate the officer salaries, right, which I may want to do, even if it's not really a requirement for tax purposes, I may just want to see the officer salaries versus anybody else. And obviously, if there's any other ways that I want to break down, different sort of departments, if you will, you can do that here. But often payroll companies have a way of setting up departments so I can get that detail elsewhere if I need to. It's just a question, and again, this is what I'm going to stress. It's a question of, do I want this detail in the chart of accounts? Do I want it showing up on my profit and loss? Is it going to be useful for me to see there? And it might. It might, especially if I have a lot of different departments and a lot of salaries in all these different departments, because then I can run my P&L and I can show this stuff as a percentage of total income or a percentage of total expenses. And I can start to get a sense of, am I sort of top heavy in terms of payroll, right? Is there a lot of officers' salaries, or am I, just where am I sort of loaded up and seeing a big burden in terms of payroll? Again, it's one of the, for most companies, it's the biggest expense that we have. So it's important, and it's important to pay attention. And sure enough, here's where, like I said, I definitely like to put payroll processing fees here. I want to see what it's costing me to process payroll. If nothing else, it might clue me into when it might be time to look around for other services where I might be able to save some money if it's starting to get expensive because I'm adding a lot of employees, and maybe the service I'm using is a smaller service and it's not really designed for a big labor force, right? So definitely something I'd want to see separately. I would not want this lumped in with software costs. Sure, I'd know where to go to find it if I needed it, but it creates a bit of friction when I'm analyzing reports. And like I said, at the end of the day, at least this is just my opinion, the way that we structure the chart of accounts really should be fashioned around, how do I want to be able to read the financial statements, and how do I want to be able to see and understand what's going on with the financial picture of the company, right? So that's the payroll part. Okay. Let me go back up here after payroll. So again, that's for a basic company. And now you can see all my wonderful notes. Years ago, I audited a well-known apparel company. Well, it's well-known now. It wasn't as well-known then. They were sort of up and coming at the time. And they sell inventory. And they shipped all their own inventory. They weren't selling on Amazon. They shipped it all out of a very large warehouse that they had in Riverside, California. And there were certain employees that only worked in the warehouse. That's all they did. So in this company's case, we also needed some of the salaries in the cost of goods sold section of the profit and loss, because these employees hold jobs centered around getting the goods ready and available for sale, which is pretty much the definition of cost of goods sold. It's the costs necessary to get the goods ready for sale, right? So in a case like that, and this is where you really have to think about the industry that the company is in and how that might impact the way the accounts are going to be structured. So in a case like that, we'll need payroll split up. Some of it's going to be in the general administrative section or the overhead section of the P&L, and some of it's going to be in cost of goods sold. Let's see, where am I? So I also had to carve out a portion of rent to cost of goods sold, because the people who ran this company didn't own the space they were in. They were renting it. And so I, as an auditor, had to walk around the warehouse and measure it. And I had to, of course, do the math and take the percentage of the warehouse square footage over the total square footage of the whole place. And then I had to allocate the rent. Their bookkeeper was booking it all to just rent expense. And I had to allocate the cost of goods sold portion of the rent to cost of goods sold. So we needed we called it rent warehouse and put that in the cost of goods sold section. And then the other line item for rent was just rent in the expenses section, right? So the industry of the company that we're in many cases is going to largely drive how that chart of accounts gets structured, right? And that's a really good example when you get into retail, right? Because that's where you get into true cost of goods sold. And I call it true cost of goods sold, meaning a service-based business doesn't have true cost of goods sold. We'll use that section of the P&L because there are certain expenses we want to describe that are sort of directly written off against income. Take an accounting firm, for example, or a bookkeeping service. A lot of times we'll take our bookkeeping staff salaries and classify that as cost of goods sold because we want to see how that compares directly with the revenue that they help generate, right? And so we do that for reporting purposes and for analysis. But the true definition of cost of goods sold, and if you ever look at a tax return for a company like that, you'll see that those salaries generally don't or shouldn't be classified as cost of goods sold. The person preparing the returns will normally reclassify those for the tax returns purpose to the regular expenses, right? Because again, true cost of goods sold means the costs necessary for getting goods ready for sale, right? So if we're in a service-based business, there's not true cost of goods sold. Again, we use it just as a reporting mechanism. So nothing wrong with it, but it's important to understand that, I think, because this way you can sort of just speak intelligently to it when you're talking to the person who's preparing the returns, and you might need to explain to them why you're using cost of goods sold in a business that doesn't actually sell any products, right? So like I said, I had to go around the warehouse and measure the square footage literally just to figure out the adjustment for their cost of goods sold portion of the rent. And again, I'll stress it, keep in mind that when you're setting up your chart of accounts, you're driving what the picture is going to look like. What is the balance sheet going to look like? And remember that, like I said at the beginning, the reason your clients are putting all kinds of money into the bookkeeping with you is so that they can get really useful data out of it. So that's also what you should be bearing in mind when you're trying to decide how to structure the chart of accounts, right? And again, that means reports. And this is why, like I said earlier, that's one of the last lessons in the Bulletproof Bookkeeping course is a deep dive into a whole series of reports that I do that I suggest sending out to every client. And one of the great things about QuickBooks Online specifically is I can schedule those reports and have them go out on a schedule every single week at the same exact time. And I usually coordinate that with the client and tell them when, I ask them, when would you like to get the reports? What's a good day for you to sit down and look them over, right? And depending on the scope that the client has sort of hired me for, it might even be a meeting that I do with the client and review the reports. With a couple clients, I do it weekly, actually, because they pay me a lot. With others, it might be monthly or quarterly. And with the lower fee clients, it might be just once a year. It's up to them. And then I always offer them the option that they can, pay me extra as a one-off one time if they want me to review the reports with them. Because I've had some clients come to me who are on a lower tier fee and say, hey, can we have a meeting where we can review the reports? And I say, absolutely, but not at your level. You can either upgrade the service so we can do it more frequently on a regular basis, or we can just do it as a one-off. And I have some clients that do kind of a hybrid where they pay the monthly fee for the bookkeeping, and then separately they sign up for one of my live support plans is how I sort of bill it out. And they're doing a hybrid, right? They got the monthly fee that covers the basic monthly bookkeeping that we do, and then they use the live support for when they want to review things or get into more detail with me. And some of the clients love that, by the way, because they don't feel like they're losing money if they're paying extra money each month for that extra service, and then they don't have time and don't use it one month. They don't feel like they're wasting money. So that's been a really good service that I've been able to offer with clients. But again, when they do it, it's usually because we want to review reports. And when we're reviewing reports, it is completely centered around how have we structured those accounts and how easy is it making it for me and the owner of the business to understand what the financial statements are saying about the financial position and the financial health of the company at a given moment in time, and of course, over a range of time. And those two distinctions really depend, or what it's sort of driven by which report you're looking at, right? The balance sheet's a snapshot, it's a moment in time. The profit and loss is the moving picture, it's a range of time, right? And then the way I like to explain the statement of cash flows to clients is that it removes all the BS from the equation, right? Especially when you're looking at the indirect method statement of cash flows, which literally reconciles your accrual basis net income to cash. And like I said, I have an hour-long lesson. It's the deepest dive I've ever done on the statement of cash flows included in the course. So the reports are the outputs, and to me, that's the whole point of it. A while back, I did a video. A lot of people that I know today found me based on this video. It was sort of a QBO versus Xero video that I did, and ultimately for me, it came down to the reporting, and that's why I sort of chose, not sort of, I chose that I like QBO better than Xero, and ultimately today, if somebody comes in the door and wants us to provide bookkeeping services, they have to be in QuickBooks Online. I won't take on a client for bookkeeping services who's using any other product, not even QuickBooks Desktop. I will do training in all those products because I know them, but I don't want to do the actual bookkeeping for anyone in any product other than QuickBooks Online. It keeps it simple. It keeps it streamlined for me and my firm. You know, I have 2 bookkeepers that work for me, and this way we have one product that we need to know, and that's it. And you know, some people like to specialize in all kinds of products. For me, that was the way to streamline and get really focused with my firm. So let's take a look at another area that raises a lot of questions about how to set up the chart of accounts. Okay, and if you're wondering, I think most of you know me well enough to know what we're using here. This is Dynalist. If you're wondering what am I using to keep these notes in, it's Dynalist. So check out Dynalist. It's the free version does a lot, and the paid version is like next to nothing. It might as well be free. So the first thing you have to do, I think, when you're starting to set up a company is ask them, who are the owners, who are the shareholders, or the stock, or the members, or the partners? And of course, that nomenclature changes based on the type of entity that we're talking about, right? Are we looking at a corporation? Then it's shareholders. Are we looking at an LLC? Then it's members. Are we looking at a sole proprietorship? Then we probably just call it owners, right? Or is it a partnership? Then we just call them partners, right? Now, when there are 2 or more owners, that's when setting up the equity section, I think, requires a little bit more focus and emphasis. If it's a single owner in a company, even if it's a corp, you can pretty much leave the equity section alone. You probably just want an account for their contributions and another account for their distributions. And you might want to group them in a hierarchy so that you get a nice total that shows here's what they put in, here's what they've taken out, here's what it all totals to, and that represents their book value in that company, right? And then, of course, if you're not doing any kind of reclassifying entry at the end of each year, which, again, normally for a company that's owned by a single person or shareholder or whatever, you normally wouldn't do that. But as soon as there's 2 or more, then you really need, I think, to put some more focus on the equity section, right? And so here's a generic version of what each one should look like. So we'll go right in here into the equity section. And I'm just using the example of if Matthew Fulton and I are both shareholders in the same company, this is how I like to do it. I have shareholder capital. So the parent account is shareholders equity and the person's name, okay? Then within that, 3 sub-accounts. I have shareholder capital, contributions, and distributions, right? Contributions and distributions should be pretty straightforward in terms of what those mean. You know, it's the same as any equity section. The capital account is really meant to distribute the earnings to. So if Matthew and I are each 50% shareholders in this corporation, at the end of the year, at the end of 2019, if that corporation made $100,000 net income, and we know the books are final, and that's our final answer on the net income for the company for the year 2019, on January 1st of 2020, could do it on December 31st too. There's arguments for or against either. But bottom line is we're going to take those net earnings of $100,000 and we're going to, what do you call it? Equity sections have a normal credit balance, right? Credits increase equity. So we're going to decrease retained earnings. We're going to debit retained earnings for the whole $100,000, and I'm going to credit his capital, and I'm going to credit my capital for $50,000 each. So basically, the capital accounts here are meant to hold and track the cumulative share of net earnings that we've each gotten based on the performance or the net income of the company each year. So that's essentially how I like to structure the equity accounts. And like I said before, I'm using the example of a corporation. So if it was an LLC, it would just say members equity instead of shareholders equity. Partnership, it would be partners equity instead of shareholders equity. You get the point, right? So that's the equity section. I get a lot of questions about that. And years ago, I did a video on this. It was with Desktop. And because somebody had asked me about it, and they said they wanted to be able to close out the equity accounts each year. So to answer his question, I didn't qualify my answer well enough. To qualify it well enough, what I should have said to him was, I don't recommend doing it at all. You know, like I sort of just mentioned, I want these to be permanent cumulative accounts, okay? hold on a second. It looks like somebody was drawing on my screen. Stop that. um, I want these to be permanent and cumulative. I want to be able to run the balance sheet as of today and see from day one, since this company was created, what does this all look like? But I get that sometimes people want to zero it out so they can see it just for the current year, right? Fundamentally, I disagree with that idea because it sort of defeats the purpose of what the balance sheet is supposed to be. It's supposed to be a permanent and cumulative account. If I want to see just what's going on that year, I can run the balance sheet and drill into any of these accounts and set the dates based on that 1 year or whatever I want to look at, and then I can get that data if that for some reason is what I want to look at specifically, right? So that's my 2 cents or 10 cents worth on the equity section, but it definitely brings up a lot of questions as far as how to do it. But if you do it the way I'm suggesting, what I think you'll find is that it will total beautifully, right? Because it'll just be very crystal clear. You'll see their cumulative earnings distributed to their capital accounts. And if there's a loss, by the way, we're just flipping the debits and credits, but we allocate losses just like we would allocate income to those capital accounts. But it will total beautifully so that you can get a very clear picture in an instant on the balance sheet of each owner's book value in the company, of what their stake in the company is worth, book value. So I like doing it that way. I'd presented that once on one of my Friday Zooms, and one of my Canadian friends said he thought it was overkill. So, and Alicia question in the chat, I am saying that when there are 2 or more, say, shareholders, that's exactly what I do, is I zero out retained earnings and distribute it to the capital accounts. Because this way it's just really clean and clear. Here is the permanent history of what their earnings are worth, what their share of the earnings that they've received are worth in the company. And that way, if they take distributions and they don't take them equally, which by the way, in an S Corp, they have to take them equally. And even if they don't, you have to equalize them and reclass the difference to a loan account or something. So in an S Corp, distributions have to be in exact proportion to their ownership in that S Corp. But yes, that's exactly what I do on the balance sheet, because it gives me a really clean and clear picture of what each separate owner or shareholder's value is in that company. Let's see, what is next after that? Like I said earlier, a lot of the areas of the chart accounts are gonna vary based on the industry. But let's look at a classic example now of what a retail P&L might look like. And I'm just getting to that part in my notes. So in a retail business, and this also probably goes for a lot of e-commerce companies, because e-commerce is really just retail but online, right? So we're going to have sales, and you might have more than one, a sales account or income account, depending on, again, how detailed do you want to be. We have the product and services list, which can be categorized in QuickBooks Online. So in a lot of cases, I don't like to get too detailed on the P&L, because I can run reports based on the product and services list, if I want to see sort of different departments and how things sold in those departments. And especially with e-commerce, we have other software that does a really slick job of getting me the data broken down, by different departments or by different product groupings. So I often don't like to get too detailed on the P&L because it's just not necessary, right? But that doesn't mean you can't. You absolutely can, and there's nothing wrong with it. Again, just keep in mind that this is what your P&L is going to look like. How detailed, how long do you want that to be? I think a lot of people will agree with me when I say that I'm a fan of keeping the chart of accounts as simple as I can, but there's a balance there, right? If I make it too simple, then I'm not really getting good information. If I make it overly detailed, then it's overwhelming and hard to read, and obviously that's no good, right? So there's definitely a balance here that has to be achieved. So we have sales, and then we have less sales returns and allowances. Now, something important to note, this came up for me a lot last year. When you take returns, you have to talk to the client and ask them. I realized that we were really screwing up somebody's numbers. I mean, it wasn't wrong in the net, but in between, things were skewed because we were getting data from Amazon, and returns were being netted out with sales, which means they were effectively being added back into inventory. And when I eventually discussed this with the client, what I learned was most of the time that inventory was not saleable. It wasn't going to be able to be sold again. So we didn't want it going back into inventory, and we also didn't want it netting against sales. So we had to remap things so that it could show up on the P&L exactly as you're seeing here, where the sales go into sales, and any returns and the refunds that are related go to sales returns and allowances, which is a contra income account. Contra meaning it goes against the income. And of course, that brings me to net sales. Sales less the returns and allowances equals net sales. That's the net total revenue, okay? Then we have cost of goods sold, which follows a similar kind of pattern. We have the purchases, or whatever you want to call it, when you actually buy the products that are being sold, okay? Less purchase returns and allowances, right? And the allowances could be a lot of things. It could be a timeliness discount for paying promptly, right? In a lot of cases, though, especially e-commerce, and especially if we're buying stuff overseas, the allowances part doesn't really come into play because in many cases we have to prepay for it, so there's not going to be a timeliness discount. But there could be other allowances. So anyway, we have purchases, which I'm just using a very generic term here to describe the expenses associated with the direct purchase, what originally goes into inventory. And then when we sell the stuff, it comes out of inventory and it goes into this account, right? I just didn't want to repeat the word cost of goods sold twice. Normally, that's what you people are calling this as cost of goods sold, okay? And then we subtract from that any purchase returns and allowances. And then we also include freight in, but not freight out as cost of goods sold. Why? Because if you were here at the beginning and you heard me explain the definition of cost of goods sold, this is the clear dividing line, right? Freight in is part of the cost necessary to get the goods ready for sale. If I have to pay for the products to be shipped to me, that's definitely something I have to pay for in order to get them ready for sale. But freight out, the shipping I pay for to the customer, that doesn't happen until after it's sold, which is why, according to at least GAAP, and this came up years ago in an audit that I was doing, and we had heated arguments, and then we did the research and we found out this was the rule, is that the freight out happens after the sale has taken place, which means it's not part of what's necessary to get the goods ready for sale. It's what happens after they've already been sold, which means the freight out goes into your overhead or general administrator or what we call a selling expense, right? And of course, you add all this up and you get your total cost of goods sold. Then your cost of goods sold subtracted from your net sales gets you to your gross profit. Now, the gross profit, again, this goes back to restructuring the chart of accounts. We're thinking, what do I want included and reflected in that gross profit number? Because especially in retail, but it's true for any business, that gross profit number is really important. The reason it's especially important in retail is because if our profit margins are structured according to a certain desired goal in terms of profit margin percentage, then we manage things heavily based on that number, right? I want to run my P&L, I want to total it by month every month, and I want to include the percentage of income so that I can look at my gross profit dollars and see percentage-wise, how does it compare month over month? What happens when a client's books are messy is that we haven't normalized the cost of goods sold. Maybe we're booking a lot of cost of goods sold directly to cost of goods sold instead of absorbing it into inventory, which means we're overstating cost of goods sold in some months and probably understating it in other months. In other words, we're not matching things up properly. But it's important to be aware of that, and that's what underscores the importance of why we do want to make sure we can absorb as much of the cost as possible into inventory so that it doesn't hit the P&L until the item is sold. Sometimes it's not logistically practical to do that, but you want to do it as much as you can because, again, we want this gross profit number normalized. I want to be able to have an expectation that when I look at gross profit, I know it should normally be, let's say, 35%. And that way, if it deviates substantially from that 35% one month, I know I've got to take a closer look and figure out what's going on. Why is it off, right? And oftentimes that will be the exact kind of analysis that leads to uncovering a serious problem, right? A client of mine discovered one day by doing this kind of an analysis that Amazon had made a mistake, and we're not talking a small amount. We're talking about like a $200,000 mistake, which when we uncovered it, then we had to put the right audit trail together, which is why I'm so hell-bent on having bulletproof books, is because bulletproof means I've got a solid audit trail so that in cases like this, we can go to companies like Amazon, who are normally too big to really care, and say, look, here's our documentation. We believe you've made an error. We believe you owe us $200,000. And it took a while and a bit of fighting, but eventually we got them to agree and credit my client back for his $200,000. So this gross profit number is critically, critically important in any business, but especially in retail and e-commerce. And then what you're seeing on my screen now is just a recap of exactly what I just said. You want to keep your eye on that gross profit percentage. You want to look at it monthly, and you want to look at fluctuations. Can they be explained? If there is a fluctuation, does it indicate, an error or an issue of some kind? So the way and this is to summarize, the way you set up your chart of accounts makes all the difference in how you analyze the numbers. That's what I want you to think about. I think a lot of people go into Facebook groups and they ask the question, or they ask if somebody can help them know how to set up their chart of accounts. The truth is, if anybody says to you just off the bat without knowing anything more that they can, they're full of it. And I don't mean really that they're full of it. Obviously, they have hopefully good intentions. What I mean is there's no way they can know without digging a lot deeper how you should set up your chart of accounts for a particular client. Because this is what it all comes down to, is how you want to analyze the numbers and how you're going to balance, like I said, the level of detail that's inherent in the chart of accounts with getting good information out of the reports without at the same time overwhelming you and the others who are going to be reading those financial statements, right? Those are some of the keys to think about when you're trying to think about how to set up a chart of accounts properly. Alicia says, what if the customer is paying for shipping? Isn't it COGS then? Well, no, because if the customer is paying for their own shipping, it's not even our expense. I mean, if we're billing it back to them, again, if it's shipping to the customer, it's still shipping that cost is still incurred after the sale is made, right? So at least according to the definition that I understand, the only shipping that's cost of goods sold is the shipping we pay for to get the products to us. Once the sale is made, it's no longer a cost needed to get the item ready for sale. It's a cost that's happening. It's a selling expense. It's a cost of actually selling the item because now we've got to get it shipped to the customer. So, I mean, in the end, if you book the shipping that you paid for to the customer as cost of goods sold, and then the customer is you're billing it back to the customer at cost, then I don't suppose it matters. If you're charging a markup on that shipping, then you probably want to book the amount that you charge the customer for shipping as income, right? I wouldn't book it as a reimbursed expense if there's a markup. We'd show that as shipping income, and then again, your shipping expense for freight out would be in the overhead section of the P&L, and obviously that difference would flow down to the net income or the profit on that. So, and keep in mind what I'm describing here is GAAP, which really technically is only necessary to follow when your company is traded publicly, or sometimes banks will, in their loan covenants, will have a requirement that the financial statements comply with GAAP, or generally accepted accounting principles. So that's not to say that you can't put it in COGS. I'm just giving you the strict definition that I came to understand, in my experience working as an auditor. And like I said, it was a big heated argument we had in this CPA firm where I was working. And then somebody just dug up the actual FASB statements on it. And then there was actually case law around the issue, where companies got into it with their shareholders. And, I don't remember the companies actually that were in the case, but that's where ultimately we found out that the ruling that the courts gave on the definition of cost of goods sold are, what I've explained today. So let's see what else we got. I had a couple other good examples. Actually, last example of the day, and we're coming up on our time, is going to be the e-commerce. So like I said, e-commerce is going to be very similar to retail on the P&L, but e-commerce has some specific things I want to show you for how I like to set things up in the chart of accounts on the balance sheet specifically. So let's go back to my e-commerce example. And so the trick here is we're going to need a lot of clearing accounts on the balance sheet. One thing I'll tell you, I put it in my notes at the end, but I'll tell you right up front, one thing I want to make sure you're clear on is that you never want to use undeposited funds in an e-commerce concern. It's just too messy. You're going to spend the rest of your bookkeeping career trying to tie out payments from sales channels with deposits and how they group together into a deposit that went into the bank account. And it's just never going to happen. Because we all know, as you can be as diligent as you can be about making sure you put the right payment method in the payments, on the sales receipts or what have you, and it's just not reliable. It's too easy for there to be a mistake, and as soon as there is, you're never going to be able to match things up properly. So I learned with my first e-commerce client, and I learned it very quickly, that the only way to do this is to create a series of clearing accounts, right? And we're going to set these up as bank accounts because, well, you'll see why as I dig into this for a couple of minutes. But for now, just take my word for it. We're going to set these up as bank accounts. But that means I need to group the bank accounts section of my balance sheet because I want to see, obviously, I want to be able to see in a click what my total cash on hand is, what actual cash I have in the bank, right, for my regular bank accounts. And then separately, we're going to create a group which I call the merchant clearing accounts. And that way we get the subtotal so I can see how much true cash I have in the bank. Because any balance is in the clearing accounts. Like if there's a balance in let's just use Stripe, for example, that as of the end of the month didn't get into the bank account yet, that's really just like a deposit in transit. So those are like receivables, but I don't actually have access to that money. If I overspend on my regular bank accounts, it's not like the money that's in Stripe is going to be able to cover it until it's actually transferred into my bank account. So it might look something like this. Like I said, we have the bank account, so I just used 2 examples. So I have, my Wells Fargo account, my Bank of America, and then I have my total bank account. So on the balance sheet, I can quickly and clearly see, here's how much money I actually have in the bank that I have access to today, right? Assuming I've got my banking all up to date, but that's another conversation for another day. Then we have the merchant clearing accounts, right? So I'll expand this, and I just have a few examples in here, but I want to talk about this for a few minutes, because especially if you do or plan to serve e-commerce companies, you're going to find this very useful. And I'll say this, if you're in the bookkeeping field or the accounting field, this is my opinion, of course, I think you should get prepared that at some point you're going to need to know how to service e-commerce companies, because the truth is, and I don't think I ever published it, I started to write an article that was essentially titled, "Every Company Should Be an E-Commerce Company." Because even my own company, where we do accounting and bookkeeping services and training, is really an e-commerce company. Every dollar I make, with very little exception, is transacted online. You go onto my website, you pay for training. Even my bookkeeping clients go onto my website, and I have a subscription that they set up to pay their monthly fee, right? We don't bill by the hour anymore. So they pay their monthly fee, and that's set up as a subscription. So really every company at the end of the day can be broken down. Maybe not every, but many companies can and probably should be broken down and thought of as e-commerce companies. So we have clearing accounts for each sales channel. And basically the way the money flows is I make a sale, and that money goes into that sales channel clearing, right? So if I sell something on Amazon, it goes into Amazon clearing. Now, Amazon is a bit of its own animal because they have the biweekly settlements, and so the money comes in every 2 weeks. And unless you're using an app, which I actually just started looking at an app this week that actually pulls the Amazon data in real time, so that within an hour it's completely up to date. You may not see the money until the end of the 2-week period, but at least you can see what's coming, right? It's called Margin Driver. So check out Margin Driver. Just go to margindriver.com. And it's a really slick app that if you have any e-commerce clients, you're definitely going to want to look at putting them into this product. This product will actually source all the sales data and give you essentially profitability for each order. It will show you, you can set thresholds and say, I want to see all the orders that either lost money or that weren't profitable by at least this percentage. Anyway, I digress, but check out Margin Driver. And then they'll post the monthly journal entries to book everything from the gross sale down to the gross profit in your QBO company. So really, really slick app. But as far as the flow of money goes, you make the sale and it goes into the Amazon clearing or the eBay clearing or the Shopify clearing. The money comes in. Then because some of these sales channels, there can be multiple payment methods, right? Like PayPal or Stripe. So as money goes into PayPal, you basically book it as a transfer out of the sales clearing account and into the PayPal account, right? eBay and PayPal are a perfect example because eBay pretty much works with PayPal. So the money comes into the eBay clearing, and then transfers go into PayPal as the PayPal clearing. And then most of us have probably worked with PayPal by now, so that works a lot like a bank account because you can pay for things out of it. And then you have the PayPal fees, which can get recorded as an expense, right out of the PayPal account. And then at that point, the money that got transferred from PayPal over to your bank account is just that. It's just a transfer for whatever that amount is. So when you're doing your bank feeds for your bank account and you see money coming in from PayPal, you just record that essentially as a transfer from PayPal to the bank, right? Same thing with Stripe, right? So if Stripe is the payment method that's being used for whatever sales channel, it's not going to be Amazon or eBay because eBay exclusively uses PayPal, I think. Shopify, I know you can use PayPal with Shopify. I know you can also use authorize.net. I'm not sure if you can use Stripe with Shopify. But either way, the flow of money is the sales, the money from the sale goes into the sales clearing. Then it goes from the sales clearing to the payment clearing account for the different payment methods. And then in the payment clearing account, you'll deal with any fees. And then the money flows from the payment clearing account to the bank account, right? And so this kind of a structure, when you have it set up this way, makes it really easy to follow that flow. And then every month, you can reconcile each of these clearing accounts to zero. Right? The basic formula is sales minus payments equals 0, right? Payment minus fees minus, in PayPal's case, whatever expenses we might have paid for equals the net amount that we end up transferring to the bank, right? So that's the flow of money. And so this is a perfect example of how setting up, the way I set up the chart of accounts, particularly on the balance sheet, it isn't just about presenting the financial information. It's actually about a workflow that makes it really easy to follow the flow of cash, reconcile everything, because the clearing accounts should all zero out. And now when I reconcile those accounts, there might be some money sitting in Stripe at the end of the month, so I just don't check off that item when I'm reconciling to zero. And I leave that as an amount in transit. But the point is, I can ensure by doing this process that nothing got missed. Not a dollar of sale was missed, not a dollar of payment was missed, not a dollar of fee was missed, because I've missed anything along the way. I'll see it. There'll be a difference I won't be able to reconcile, and that will force me to dig in and find out where that difference is coming from. So e-commerce is a great example of how putting some extra thought in to how you structure the chart of accounts can can make a huge difference. And let me see what else I got. We're just about out of time, and I see people leaving because they probably have to go. That's basically it. So the e-commerce company, like I said, is a great example of where it goes even deeper than just presenting the information. It's about the workflow and following the flow of the money. And so at the end of the day, I'll just kind of summarize with this, that there's no right or wrong answer on how you set up the chart of accounts, as for the most part. I mean, obviously there's things, expenses don't belong on the balance sheet and vice versa, obviously. Even that can be subjective. We have some costs that we pay for that, like I was talking about earlier, it's not practical to absorb them directly into inventory. So instead we stick them on a balance sheet account, like logistics costs. Sometimes the cost of shipping when we're shipping a lot of products in from China. The way that it's charged is based on weight, and there's no real easy practical way to break down the weight of each item and absorb those logistics costs into the cost of the inventory. So what we do is we pool them in a logistics WIP account, and then we have an assumption that we use based on what portion of those costs are getting are getting used up, in effect, based on how quickly do we think we sell the products that we shipped in. So if on average we think from the time the products come in to the time the last one that we just shipped in got sold out can be 4 months, then we'll divide up those costs over 4 months and amortize them off the balance sheet, right? So we have a logistics WIP on the balance sheet, and then every month we credit that account and debit the cost of goods sold account for those logistics costs. So there's really no right or wrong answer, as long as you're getting the information you need, and as long as you as the accountant or bookkeeper are able to work with your client and read the financials together, and the business owner with their operational knowledge and the accountant with the financial knowledge between the two of you. If those financial statements make sense and everything looks accurate, then it means you've probably set up the chart of accounts in the best way possible that works the best for you. And that's pretty much all I've got for you on that. So I'll stick around for another minute if anybody has any questions, but like I said, I see people kind of dropping off here, so feel free to unmute and ask away. And if any of you watching this are from Kate's group on Facebook, just make sure you get her affiliate link if you do ever decide to sign up for the Bulletproof Bookkeeping course.
Hi, this is Robin Lucas. Hi, Seth. I actually have an e-commerce company that I just took on, and I guess I'm a little confused on the Amazon clearing, because he currently what he's doing is invoicing creating an invoice when he gets his statement from Amazon, and he is when the payment goes into his checking account, he's just matching it up with that invoice as account receivable.
You could do it that way. I don't like to do it that way because there's a lot of details in between. In fact, I have a whole process with Amazon specifically where I take their biweekly settlement report, which you can download from Amazon, and actually cut it up into a pivot table, because depending where he's going in his Amazon account, there's different levels of detail that they give you. And if he's doing what most people do, he's getting sort of a minimal level of detail on it, which means there's a lot of costs in between, which he may not care about. But I like to see all the details because I like to know. Like I said earlier, I like to analyze this stuff and see, is one of these cost line items actually running away and getting out of hand? Is there a problem? Did Amazon make a mistake? They do make mistakes, right? So what we do is, and the other thing to keep in mind is that Amazon settlement report oftentimes crosses over the end of one month and into the beginning of the next, which means you really need to divide that up to get your sales and cost of goods sold in the right periods, right? So if he's just doing an invoice based on the settlement date for that whole reporting period, he's understating sales and cost of goods sold in one month and overstating it in the next, which again, may not be that critical for him. But when you're dealing with, like, one of the companies that I was dealing with last year and still do, they started getting to the point where they're doing $1 million a month on Amazon. So then it's significant, right? The amount that we're talking about there. So again, I still follow that same kind of process with Amazon, where I do run it through the clearing account, because I bring all the sales in, I account for all the fees, and then that difference, that net. Because the other thing is, and I don't remember if they show this clearly in that sort of first level of reporting that you can get from Amazon, but a lot of times Amazon will hold a reserve. And so that reserve gets carved out of what they fund you, and really that has to go to an asset account because it's money they owe you. They just hold on to it in case there's chargebacks or reversals of some kind. They hold that back from you to make sure that they can cover it, that they don't have to pull funds from you in order to cover other costs as they come up. So, so again, concise answer to your question, there's nothing wrong with the way he's doing it necessarily, but just keep in mind the implications that I laid out in terms of where it can, sort of throw things off.
Well, I'm highly questionable of this process, and I've asked him a few times to just give me a good idea, because I don't see where he's accounting for all of the fees, and so he's not getting a true cost of goods sold or return on investment. Or I mean, he doesn't. Yeah. I can't see the big picture by what he's doing, and so can you tell me? So he can detail up, I guess, his report he's pulling from Amazon.
Yeah, first of all, there's apps that you can use. Like if you look into Margin Driver, I've just fallen in love with this app. Have him look at that. If Amazon is the only place he sells on, he doesn't sell on any other sales channels, then A2X is great. The problem with A2X is it's only for Amazon. So my clients, in some cases, based on my suggestion specifically, sell on more than just Amazon. Because if you're putting all your apples in the Amazon basket, you're taking a huge risk. Amazon can shut you down like that, no questions asked, if they even spell something wrong with what you're doing.
Well, his products in grocery stores and retail stores and Amazon, and then he has website sales. Okay.
So the brick and mortar stuff, unless they provide some kind of an online portal, you're going to be hard pressed to get that into an app, right?
They're more of a purchase order type deal. So they send him a purchase order, he sends it out. So it's all one cost involved. There are no fees there.
Gotcha. So it's straightforward. We don't have to worry about that. But Margin Driver will pull in Amazon data real time, up to the hour, and they book things on a calendar month, so you don't have that splitting issue that you have with Amazon normally. So they account for that, and then and they just, like I said, they can give you real time data. You can see by product what's being ordered throughout the day, and it should be really good data for a business owner to track. But the real question you have to consider, and you have to ask this of your owner in a polite way, of course, is does he care, right? I had a client who told me when I showed him the difference of the level of detail they were using from Amazon and the level that you can go to if you use the report that we pull, and he was like, yeah, this is too much information. And I said, but do you understand that you might be actually losing money selling on Amazon and you wouldn't know it? And which is, I mean, maybe that's not the most accurate statement, because the truth is, if he's losing money, he would see that even at the summary level, but maybe not, because again, if you're not seeing that reserve, that's a big issue, right? If they're taking it, they may not be taking it. So there's just if I know that there's more moving parts inside the machine, I want to see all those moving parts so that I can account for everything and understand it. I learned a lot doing this and getting into the nitty gritty, because I was starting to analyze every line item that came over from Amazon. And at one point I saw something called a clawback. I'm like, what the heck is a clawback? I don't know what that is. It sounds like something they just made up and charged them for. But then I Googled it and I learned that it has to do with commissions, and it's like a commission reversal. So, but now I understand what that is, and I can explain it to them. And I don't describe every detailed line item like that from Amazon on the P&L, but at least I know, okay, that should go against the commissions expense, right?
Okay.
So, and that way I'm getting a true assessment of what it's really costing to sell on Amazon and how that breaks down.
Okay, great. Thank you.
You're very welcome. All right, anybody else? All right, I'm gonna go because I don't know if you just saw, but Slack popped up. Oh no, you weren't because I wasn't sharing my screen. But one of my bookkeepers is pinging me, so I gotta go see what she needs help with. And that's my story. I'm sticking to it. So I will get this up on the website. Remember, if you did come here by way of an affiliate like Katie or Hector, just make sure if you do decide to sign up for the course that you get their affiliate link so they get credit for sending you, and I send them a little thank you. And that's my story, and I'm sticking to it. I will see you all around on the web, I imagine, maybe in person at some point. QuickBooks Connect, who knows?